Every trader says they have a setup which works within the market, but they can't explain to you exactly why it works. And for me, there is a very specific 1 hour window in the morning session which repeats near enough every single day. And it's been responsible for majority of my multiple 5-figure payouts across my funded accounts. And by the end of this video, you're going to understand completely when to sit in front of the chart, exactly what you should be expecting from the market, and most importantly, how you should be executing on it. And on top of this, I'm going to be breaking down this exact strategy in a backtesting session in this video so you can see exactly how you can be approaching it every single day. So with all of that being said, let's get into this video.
Before we get into the backtested results for this model, I firstly wanted to break down exactly the elements I use to framing every single one of those trading setups, and I'm also going to break down what makes this range very high probability. And recently I've been seeing a lot of you find success with this model, so I thought why not share what makes it even more high probability. So going back to this, understanding the model, if you're new to my videos, this is where I teach regarding time-based approach and time-based ranges. You can see right here, this is one of my ranges for the New York session, and this is all on Eastern Standard Time. So this range starts at 8:12 and it finishes at 9:12, and all you're looking for is one side of the range to be taken. And a bit of insight on these ranges, they're all framed off the daily candle cycle. So there's time cycles within the market. This is one of the cycles that the algorithms actually using, and I'm not just making this up. You can look at the results that I'm about to show. Not only that, you can look into the charts yourself. And this trade I'm showing you right now, today's date is the 15th of October 2025. This trade was taken on the 14th of October 2025. So using this framework, you can see this dark gray area, this is the range. So this starts at 8:12, finishes at 9:12. All I'm looking for is the market to take out this low, and this is 9:30 right here. I'm on the 5-minute time frame, so all I'm looking for is a shift in delivery to tell me price actually wants to trade higher and target the buy side liquidity. So that's all I'm looking for, the target at this high. Anything above that is just bonus points pretty much. And once we close above these 3 down close candles, that's where we shift delivery. And don't worry, I do have a video coming out going over these 3 candles in particular for a change in delivery. So once the market closes above, this is where we shift delivery. And now we can trust a buying setup. So this is where we can buy, looking to target the high of the range, and this is from 8:12 to 9:12, and that's where the delivery finishes. And we're going to go over what makes this high probability. That's pretty much the elements to the model. It's very simple and very mechanical at the same time. So this is the first range, 8:12 to 9:12. All you're looking for is one side of the range to be taken. Once the market shows you a shifting delivery and it wants to trade higher, you're looking to target the buy side liquidity. Once the buy side liquidity or the sell side liquidity gets hit, so the opposing end of the range, this is where you square your position. And some days you might find a trade 5 minutes into the open and you'll hit your take profit within minutes. And that's exactly where the freedom of trading comes in. You've made your money, now you get out the market, you don't want to spend any more time looking at these charts. What really makes this model high probability, or what makes a trading environment high probability? So 9:30 is very important because you always want to see price seek liquidity. So either below the range or above the range. This is where we're going to have the range, price is trading, and then we trade below the range. This is going to be called price discovery. It's discovering what it wants to do into the 9:30 open. So once we take liquidity, I'm looking for a shift to target the opposing end of the range, and that's all I'm looking for. And you need to be very quick and on your toes because this is going to happen within minutes. Price is going to take out the low, shift delivery, and immediately run to the opposing end because you're trading against some of the fastest, smartest, and best algorithms in the world that are pairing liquidity at the same time you're looking at the markets. So if you're not able to make a decision like that, that's going to be the difference between you making money and losing money. That is why I teach based on a time-based approach, because you're not reacting to the market. You're able to predict exactly what should happen. If that happens, then you're going to get into the trade. Like right here, if price takes out this low, you know you're going to look to target the opposing end of the range. And this is another key factor that makes a market high probability, is finding a small range. So if the market creates a small range before the New York session, this is usually going to mean that we're going to have a large range. But what makes this low probability is when we have a large range before New York session. This is typically where we are going to consolidate or chop around, and there is a few examples for this that we are going to get into as we get later in the video. And then the next one is a change in the state of delivery which takes liquidity. So order blocks which are formed within a liquidity pool are always going to be very high probability. So let me go back to the previous example. So moving back to the previous example, you can see right here, this is our range. Once we trade below this low, this is where we take liquidity. So this is where an OB is formed within a liquidity pool. So this is what makes it high probability, because as it's already taken sell side liquidity and closed below the liquidity pool, if the market's going to shift delivery, it has to close above that. If it fails to close above it, then we can look for more downside in the market. But once it closes above it, that's where we have a real shift in delivery, because this is an OB that took liquidity. By definition, a order block actually is a change in the state of delivery, and the high probability order blocks are always going to form within a liquidity pool. So this takes liquidity, confirms the OB because we shift delivery, so closing above it. Going back to the definition, what is the definition of an order block? Change in the state of delivery, closes above. Now we can look for the upside, and that's exactly where the market will start spooling to the buy side liquidity. As I've given you insights regarding the model and what makes it high probability, let's move on to the back tested results of exactly this same approach that I used. Okay, so moving on to the 1 month back tested results and then the 9 month back tested results as well, only trading the blueprint range. So that's from 812 to 912, and that's my time-based range. So you can see the account's net P&L at the end of April was $10,475. The account started at $2,000, and you can see the total trades were 18. So there was 15 trades taken in April and then 3 trades taken in May. The total trade win was 66%, and you can see the days of the winning streak, day wins, and the average win or loss was 2.75. And you can see the average drawdown periods as well. So this was very aggressive. I went in pretty aggressive, just going for more trades, showing you what the ranges can be done. And if you did want to filter regarding the high probability process I did mention, then this P&L would have gone up even higher. But I wanted to keep it simple. You guys can see a $2,000 account, net P&L was $10,000. And this is all very mechanical. Like if the market does this, trades below the range, then I'm targeting the opposing end. That's it. There's nothing else to this. And then looking back to the 9 month results, you can see that this was a $10,000 account. Again, the win rate stays around 60%. So anything above a 50% win rate, you have something very special within the market. This is forming very often. And once this forms, you need to capitalize on it to its fullest potential. And you can see from the $10,000 in around a year, it goes to $90,000. And this is all trading mechanically. You're focusing on the setups. Win or loss, you follow the system. There's going to be days where you lose, but the winning days are always going to be higher than the losing days. And that's exactly what a profitable system is made out of. So you can see the monthly gains was around $22,000. Weekly gains were around $6,000, and the daily loss and gain was around $4,000. Framing this trading setup was best done on Monday, Wednesday, and Friday. So I'm guaranteeing you one thing. No one else on YouTube can guarantee this. My model is going to form minimum 3 times out of the 5 daily candles. Like, who can even guarantee this in the trading space? They can't, because they don't have anything that repeats just like this within the market. And this was 1 month back tested results. And you might be asking, why did I pick April? Well, April was the only month where I had the lowest P&L. Like every single other one of these months, I had a higher P&L. So I picked the one that was the lowest just to show you that this is the potential that this model has, and this is the lower side of the potential. And even this right here, this is over 9 months, but following this strategy, even after you're losing days, you still follow the strategy and go into the markets every single day with a clear head. And you know, regardless of the loss, this is going to repeat. Even if you take a win, even if you take a loss, this is going to repeat. And that's truly what makes this approach to the market very special. So I would say consider yourself lucky, right? Because you're understanding this approach to the market that 99% of people never get to do, because the way you stumble upon this video was researching regarding time, and you wanted to learn more about time within the market. And I've taught you exactly the things to focus on with the results, and not just from my results, from my students as well, who are following this exact same thing. And what I've given out for free on YouTube is basically the tip of the iceberg. If you wanted to learn more regarding this and what actually goes on within the market and the true cycles, so this is one of the cycles, but if you wanted to know exactly about the more cycles within New York, the London, and even Asia as well, that's exactly what I break down inside of my Blueprint Academy. Academy. And if you did want to join that, you can go into the first link in the description down below and apply for the program, and then me and you will have a interview process. With that being said, I'm going to move on to the chart and break down every single day from last week, Monday to Friday, of how the model formed and how you could have capitalized on it. So this is just recently. So moving on to the chart, I'm going to break down every single one of these trading days from Monday to Friday, which lead up to the start of October. So the first day is going to be the 29th of September. So easily you can see right here, we have sell side liquidity, which is resting below this low. And we have buy side liquidity, which is resting above this high. So all we're looking for is one side of this range to be taken. However, if we look at the bigger picture, you can see that we also have sell side liquidity below this low. So we have an equilibrium, a high, and a low. And oddly enough, the equilibrium falls at the low of the time-based range. So all we're looking for is liquidity to be taken right now. Amazing. So as you can see, we take out the sell side liquidity, which was below this low and this low. And then we have these three down close candles, going back to the study that we spoke about before. Market shift delivery right here. This is where we can look for a buying setup and look for the upside. So we're going to target the buy side liquidity, and a stop is just going to go below this wick right here. And all we're looking for is to get tagged into this position. We get tagged in once we shift delivery, and this is where we have a winning trade. So this looks identical to the one that I broke down right at the start of the video. And these are two different trades. You can see it looks pretty much identical. This is because every single one of your winning trades are going to look the same or similar to the previous one. And do you know why? Because when you have a repeatable process, this is exactly what all your trades will look like if you look through your journal. So exact same scenario on Tuesday, you can see we have buy side liquidity, which is above this high. We have sell side liquidity below this low, and we also have sell side liquidity, which is resting below this low. All we're looking for is one side of this range to be taken to target the opposing end. So amazing. As you can see, we take out the sell side liquidity, which was below this low. Once we do that, what happens? We push to the upside, but no real change in delivery because there is no three down close candles that I'm looking for. Now, finally, this market pushes higher, closes above this. So now all I'm looking for is the market to confirm it wants to push to the upside. And the confirmation is going to be if it utilizes one of these fair value gaps, which is right here, as an inversion level. So this 50% I want to see respected. If 50% is respected, then I can trust a buying setup to the upside. So as you can see, we do push to the opposing end of the range. A very choppy market, but eventually it did deliver. However, if you take a loss here, you try the long, price pushes to the upside, but then stops you out, you're allowed another trade. So you should take two trades in the same direction you expect the market to go. If they're both wrong, then you're just wrong on the day and you can come back the next day. But you can see right here, we take out the low. So this could be your first loss of the day. However, you see it hold up this inversion level, holds it up, this is worth the long to the upside, and then we trade into the buy side liquidity because you know the draw should be higher and we should target this high. So now let's move on to Wednesday. We've had two winning days. If you want to consider this a loss, so you took one loss, but the second trade made it up. So we've taken three trades, 2 wins and 1 loss so far. So moving on to Wednesday, you can see we have sell side liquidity, which is below this low. We have buy side liquidity resting above this high and buy side liquidity resting above the time-based range high as well. All we're looking for is 930 to take out one side of the range to target the opposing end. Either it takes out the high, we look for the low, or it takes out the low, we look for the high. So amazing. As you can see, we take out the low of the range and then immediately run to the opposing direction. If you made it this far into the video, just take a step back. Look at what I've just showed you. Look at exactly what the market just did. Do you think this is random, or do you think something that I'm teaching you the market's actually referring to? Because look exactly what it does. Takes out this low and immediately turns. Day like this, you just have no trade because unless you just bought it down here, trading purely mechanically, then yes, it's valid. But again, I'm probably not going to be able to catch this because immediately runs the low, flies to the upside. So Wednesday could be a day that you don't take a trade at all because the model's already delivered. Once the model delivers, you don't have an edge within the market. So there's no point of forcing an edge out of the market, which doesn't exist. So Monday and Tuesday, we had good trades. Wednesday, pretty much no trading day, but the model did deliver again. And now we have Thursday. You can see exact same scenario. We're looking for the market to either take out one side of the range. Over here, we have buy side liquidity above this high, sell side below this low. All I'm looking for now is the market to take out one side of the range. So amazing. As you can see, we take out the high of the range and also shift delivery. This is exactly where I can sell from, targeting the sell side liquidity. All you got to keep in mind right now is this is a short before the 9:30 open. So although it can form and it can play out, there is a risk that price stops you out again and then trades to the downside. So just take this with a little bit of less risk. There we go. Nicely, we take out the high, shift delivery, and then trade into the opposing end of the range. So Monday, we had a winning trade. Tuesday, we had a loss and a winning trade. Wednesday, there's no trade, but the model formed. Thursday, there is a winning trade, and you can see we take out the high and then target the low. So let's move on to the last day, which is Friday. But you can see already you're up on the week. The model's delivered pretty much every single day, and it's delivered it within 5 minutes. Imagine trading for 5 minutes a day. That's exactly what my model offers, and I can't believe I taught it for free. And now we have Friday. You can see we have the high of the range and we have the low of the range. All I'm looking for is one side to be taken and then targeting the opposing end. So as you can see right here, this is where the market shifts delivery. We close below these up close candles. So midpoint of this gap is actually worth a short for me, 50%. And I'm just putting a stop above this high and then looking for the downside for a 1 to 3 or 1 to 2.5 trading setup. And there we go. We have a loss on Friday. Trading the model purely mechanically, exactly following the process. Price pokes us out and then trades to the downside. And that's exactly what's going to happen sometimes, you know, like the market's going to poke you out or just take your stop and then run to the opposing direction. The only thing you can control from this scenario is not over trading and not over leveraging. You took the loss, which is fine, but overall you're up on the week. And one thing I would recommend, if you're up on the week, don't even look to trade Friday. Use this as an extra weekend day. You trade for the freedom of time. This model, my approach, gives you the freedom of time. So with that being said, I hope you did find this video insightful. I will be going into understanding the 3 candle reversal in my next video, to breaking down the order blocks with change delivery, what makes them high probability. And if you did want to learn more about these markets in a lot more detail, going into exactly understanding the why, then you can obviously apply for my Blueprint Academy. With that being said, remember I'm rooting for you and I hope you do find success in this business. As always, enjoy the rest of your day.